ADP just dropped a bombshell. 32,000 private payrolls vanished in November. And here's the shocking part. While large and mid-sized businesses hired, small businesses slashed 120,000 jobs. That's the biggest gut punch since the last recession scare. And the Fed, they're in complete denial mode. They're worried about rising inflation, but they can't see the small businesses. We're talking the heartbeat of the U.S. labor market have gotten squeezed to the point that they can no longer hang on. And where jobs go, inflation follows. Now stay tuned, we're going to break down why this unexpected surge in layoffs means we're about to spiral into an all-out economic crisis. But more importantly, I'm going to show you how to come out of this wealthier than ever. Plus, tonight's show is brought to you by Immix Biopharma. You can find them on the NASDAQ and symbol IMMX. And they're a leader in relapsed refractory AL amyloidosis with game-changing CAR-T tech hitting huge milestones. And wait till you see this chart set up, because Immix has been a big winner for my viewers, and I'm spotting a breakout pattern pointing to a 54% surge higher off its 30-day volume profile. This is one trade you don't want to miss. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, ADP, they're the payroll giant that tracks 26 million jobs. And without the next non-farm payroll report until December 16th, the ADP report and the weekly claims data is the only pulse we have on the labor market right now. In fact, private payrolls decreased by 32,000, now falling 4 times in the last 6 months. This is the biggest job loss since 2023, and it's just the beginning. The problem is it's all focused on small employers who laid off again 120,000 workers. But the bigger issue here, it wasn't just limited to small businesses. Now, you remember earlier this week, we talked about those manufacturing PMIs. And what did manufacturers say? They're cutting hours and they're cutting jobs. And now we're starting to see it show up in the payroll report. Goods employers laid off 19,000 workers. That's the most since COVID. And if you step back, even those who are lucky enough to have a job, they're getting squeezed too. Year-over-year pay for job stayers rose 4.4%, down from 4.5% growth in October. For job changers, pay was up 6.3%, slowing from 6.7% growth the prior month. And Dr. Nella Richardson, she's the chief economist at ADP, she nailed it. Hiring has been choppy as of late as employers weather cautious consumers in an uncertain macroeconomic environment. The translation for small business owners, they're in survival mode. They're at the end of their line. Now, I want you to understand this exact pattern, where you start to see small business layoffs and there's followed by a broad contraction in payrolls. This has preceded every single recession of the post-war era. And this isn't the only data we have. We've got a ton of it that says we're headed into a recession early next year. So what we're facing here isn't just a small business problem anymore. It's about to become a national problem that explodes the minute we turn the calendar into 2026. Now let's dive in, because that 32,000 job loss, it's just the beginning. Now, AI, it's not just a buzzword on earnings calls anymore. It's becoming the excuse companies are using to cut headcount. And what they're really trying to do is they're trying to protect their profit margins. And Goldman analyst Ronnie Walker, he nailed it as he outlined the key takeaways from this past earnings seasons about the labor market. He said rising layoffs, the growing influence of AI on workforce strategies, and easing wage pressures all signal a shifting labor landscape. And the problem is for workers, what this means is they're about to see their bargaining power evaporate in a big way. And here's the proof. Let's check out this chart of average hourly earnings of production non-supervisory employees in blue against the unemployment rate in red. And I want you to see that relationship of declining wage growth and rising unemployment. It precedes every recession. Those are those gray bars. Small businesses right now, they're just a warning sign of what's to come. They're just the first shot that's being fired. So what we're facing here is it's not just white-collar jobs that are about to go. More factory workers, they're about to lose their job too. And this is all happening despite the fact that everyone keeps saying that U.S. manufacturing is coming back and in a big way. But when you look at the data, it really doesn't look that way at all. Now, industrial production rose 0.1%, but the big bombshell, capacity utilization in factories. This is a measure of potential output being used, eased to 75.5. The overall industrial utilization rate, that held steady. And what I want you to see in this next chart is where capacity goes, jobs follow. And here's the proof. Let's take a look at capacity utilization in blue against the unemployment rate in red. Let's go back to late 1980s. What do you see? Capacity utilization starts to come down, and what happens? The unemployment rate kind of flattens out, and then it turns higher into the recession. You see it happen going into the dot-com bubble. Capacity utilization is tumbling, the unemployment rate is rising. Same thing in the global financial crisis. And now look, we continue to see a downward trend in capacity utilization. All this means is we're going to be facing another recession next year. And the problem is, this is starting to spill over into the services sector. The one place everybody's been saying is completely bulletproof, but not anymore. The Institute for Supply Management's index of services has edged up a 0.2 point to a 9-month high of 52.6. Now, in the headline, this is fantastic news because what it does say is that the services sector is rising. If you have rising activity, that means it's from consumer demand. And what that means, of course, you need more employees. But underneath, that's not what we saw. Employment contracted for the 6th straight month. And what is the big reason behind this? The same problem small businesses are facing. Prices keep going up. They're getting squeezed at the margin here. The ISM's index of prices paid for services came in at 65.4. This is the slowest growth in 7 months. The problem is, it's still historically high. And yet this figure indicates some easing of inflationary pressures. But the issue that businesses are facing, we see this with manufacturers and in the services sector, is they know they're going to have to push these higher prices on. They can't continue on. And so the bottom line is they're getting squeezed at the margin, and that leaves them with only one option to survive, is lay off workers. And the proof is in this chart of corporate profits after tax in blue against the unemployment rate in red. And I want you to see very clearly that when corporate profits fall below that horizontal black line, that's when they're in contraction. What happens? The unemployment rate goes up. You see that in the early 80s. You see it in the 90s, 2000s, and even during the global financial crisis. And where are we at now? You can see it very clearly. Corporate profits, they have contracted, suggesting we're headed into a recession. And again, this happened 2001, 2008, was likely going to happen in 2020 had it not be for the pandemic. And what you're seeing in the charts is the odds of a 2026 recession just shot up. The other issue here, when we look deeper into the data, backlogs, they're down for the 9th straight month. How about export orders? Down 5 straight months. And inventories, they're rising. Remember, this is what's been keeping workers there, and that means companies have been building too much stuff that nobody's buying. Now, the good news is new orders, they've been stacking up for 6 straight months. Problem? Not enough to maintain the existing workforce. And the issue is it's not just manufacturing, not just services, not just small businesses, even the oil industry. They're facing another round of layoffs, especially after that big one. And check this out. Rig counts, they're declining rapidly, as you can see in this chart. Now, the good news for the average American consumer, lower pump prices give some relief from inflation, but it's not enough to make a difference. So the bottom line for the oil industry, fewer rigs means fewer workers. And if oil stays in the low 60s, and it does look like that's going to happen, particularly as we continue to see massive bills of product, we're talking gasoline and distillates, look for another big round of cuts next year. And we have some confirmation that consumers are already cracking. More Americans are being forced to trade down at all income levels. Dollar Tree reported better than expected profit and raised its full-year earnings outlook, a sign that the discount retailer is capturing more spending from stretched shoppers. The problem is, when companies like Walmart, Dollar General, Dollar Tree, when they do better, it's a clear sign of stretched budgets and consumers. They're going to be forced to cut their discretionary spending just to afford the staples. So if you thought there was hope in a rebound in manufacturing and services, there's no chance as inflation stays high and more workers hit the unemployment line. This is no longer a forecast. It's a sign of what's to come in 2026. Now here's the good news. You are not powerless. And this storm is going to create a once-in-a-decade opportunity for you to act and act fast before everyone else figures out what's going on. Because these cycles, they create a massive wealth transfer, and I want you to be on the side that comes out ahead. Now, number one, we know the Fed is trapped here. Sticky services inflation is a problem, but the collapsing labor market means they can't hike anymore. That's off the table. Now, the problem is that their upcoming meeting, that's going to be around December 19th. Everybody's been saying right now that they're going to hold. That's what we're hearing from the Fed speakers. Market says they're going to cut. Reality is, by January, they're going to be forced to aggressively cut rates as soon as that unemployment rate shoots higher. And that's going to be rocket fuel for things like gold, treasuries, utilities, and high-quality dividend payers. Now, number two, you've got to get ahead of the pandemic because once this thing goes, the exits are going to slam shut. Top defensive sectors right now, we're talking healthcare, consumer staples, and utilities. They're already quietly outperforming the Magnificent Seven, who's getting all the headlines. Remember, I told you, it's time to cut back on those gains, pocket them, and look to rotate. Number three, cash no longer trash. Remember the bond king Jeffrey Gundlach, he says 20% of your portfolio in cash. Are you starting to see why? It's the labor market falling apart. It's the squeeze in the dollar. It's the Japanese yen carry trade. It's all coming to fruition here. And he says if you've got 20% of your portfolio in cash, you're going to be in a great position to buy the dip. Alternatively, look to be long the dollar here. Remember, if that dollar short squeeze goes off, you want to own what everybody wants. And finally, you've got to keep stacking skills that AI can't touch tomorrow. Complex problem solving, relationship selling, trades, healthcare, those are all jobs that survive the next 5 years. So yes, 2026 is going to be rough on Main Street. But for those who are prepared, what it's going to be is the greatest wealth transfer setup since 2009. And now you're in a position to come out wealthier than ever. And speaking of a great wealth transfer, one of the biggest winners for my viewers has been our sponsor, Immix Biopharma. You can find them again on the NASDAQ symbol IMMX. And when you see this chart setup, it's setting up for a 54% move higher. Stay tuned, because right now, Immix Biopharma, they're on fire. They've been developing NXC201, a cutting-edge keratin therapy for relapsed refractory AI amyloidosis. It's a serious condition with no approved treatments and tough odds for patients. Their progress this year is turning heads, and the future, it looks incredibly bright. Now picture this, in their US trial, Nexicart 2, they've already hit a 70% complete response rate in the first 10 patients. That was shared at ASCO 2025. And that's huge compared to the 0 to 10% from the current options. And with over 100 patients treated across programs, responses are holding strong, talking about building momentum fast, which is adding the catalyst to their stock. The real standout right now, zero neurotoxicity in AL amyloidosis cases, and super short cytokine release syndrome, often just a day long. This top tier safety announced earlier this year opens the door for treating more vulnerable patients and rolling out the way to more hospitals, making NXC201 a game changer for real world use. And on the regulatory front, they scored big with the FDA's RMAT designation, speeding up development. Plus, orphan drug status in the US and the EU. They blew past 50% enrollment in their key trials this fall, setting up for BLA submission in 2026. And they just appointed a chief commercial officer to gear up for a launch. Momentum again is skyrocketing. The market potential is huge. Over 38,000 US patients are desperate for options in relapse cases, spelling out a multi-billion-dollar opportunity. As a clear leader, Immix is primed to capture it big time with their late 2026 launch pad. And adding fuel to the fire, they brought on biotech powerhouse Nancy Chang to the board and secured a strategic investment from Goose Capital. Plus, their ingenious platform is eyeing expansion to other serious diseases like lupus, unlocking even more growth avenues. Now, let's take a look at this incredible chart setup. First, we're going to look at the 30-day window here. That red line, that's the 30-day volume profile. And you can see prices rallied up there and pulled back. It's holding support today. That former area of resistance, it's now an area of support. Now, let's zoom out to the weekly chart. This is where it gets exciting, because you can see weekly support way down there in that supply zone that I identified. And look, it's moving up to that big one above. And what this is setting up for is a potential 54% rally. And you can see it's on the back of rising momentum as the RSI and the MACD are trending higher here. As you can see, Immix Biopharma is poised to revolutionize treatments and create massive value. You want to put IMMX on your hot list, because right now with the stock, the sky's the limit. And as always with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades and use your risk control levels when you do. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.